seen this chart, and this chart will generate a current account surplus, and the financial account will be in deficit because they will take that money and they will put it into US dollars. And so, if you will, this is dropping Mont Blanc into Lake Geneva. It is this bonsai scheme in a very direct sovereign intervention in the value of its exchange rate. The Chinese renminbi should be rising. It's being prevented by the Ponzi scheme. That Ponzi scheme will be one of the factors which takes interest rates, aided and abetted by the Federal Reserve in their miscalculation with regard to transitory inflation. It'll take interest rates to the bottom again, and it will bid up asset prices. Presently, I favor the bidding up of the asset price, which is most extended below its mean. That would be the 30-year Treasury security. If we go back 14 years ago to 2009, the most extended below its mean was the S&P. If Stan is right and we get a severe and shocking economic downturn in the US, I suspect the S&P will move away from its mean, way below its mean. And in due course, it will open up a great opportunity to buy it. Because again, with all of this money being created from the Asian Ponzi scheme, inevitably it's going to bid up property prices, stock prices, private equity prices, and bond prices.
I still believe that, but I do think, like the 68 to 82 period, will have some big swings. So I think the way to make money the next 2 years in the equity space is to be patient, because I do think we have possibly some rough roads ahead, and I do think the central bank will respond in some crazy way that will give you a period like 70 to 72 where you can make money, or 76 to 78 when you could have made.
The crazy way, for me, it has been the path just taken. When you've got debt, a debt load which is almost 4 times GDP, it's not pleasant. Again, it's a function of economic circumstances overseas, but it's tenable as long as you keep the cost of servicing that debt minimal. So you'd have absolute very low interest rates, or in real terms, you'd have flat to negative real rates. But in the last year, I would say the folly of the Federal Reserve has been this rise from 0 to 5 percentage points. We will pay for that folly.
You could have made a lot of money. And also, for me at least, I think the currency markets are very interesting. But I think this is a movie I've never seen anything like it. So I'm going to be very careful not to dig myself in a hole when I don't have a strong belief to come out, because I think the opportunities are going to be amazing as this movie unfolds in the next year in macro and in equities.
We have seen it. It is a paradigm shift, but it's a paradigm shift since the Asian tiger. That's not a reference to a tiger hedge fund. That is a reference to the Asian sovereign crisis, currency crisis of 1997, 1998, when a host of economic countries were forced to devalue their currency as there was an exodus of global capital, and where long-standing political leaders were shunted out of office. That created a change whereby an economic growth model wanted to rely on domestic sources, and by and large looked to close its capital account, so looked to close off the avenue of overseas investors to invest in the most exciting but most volatile economic upside stories, which have been these Asian emerging markets. But in closing their capital account, they have the paradox, again, wise men paradox. The paradox of today is that the 80% plus of the world's surplus savings are invested in America. Not because that's where the greatest investment opportunities are found. Of the world's surplus savings are invested in America. Not because that's where the greatest investment opportunities are found. Try funding another railway line. Silly example. Try finding another railway line in Mozambique from the center near the coal deposit to the coast. That would add up. But probably Mozambique, if it had surplus capital, surplus savings, would be investing in US treasuries. So that is the paradigm shift. Growth is a function of population growth. Nada. Productivity growth. Nada. Now, why is productivity growth nada? Because private sector investment it's not nada, but it's muted. Why is it muted? It's muted because of income disparity, of the destitution of the working population, something that the Federal Reserve's interest rate hikes only aggravate further. People can only get by in life with taking on more debt, and debt, or the expansion in debt, ends up being the fulcrum, ends up being the sole mechanism to create GDP growth. So debt's going to go up. Now, debt is a liability. Debt requires an asset. And so it's like accounting ledgers. And therefore, there's just a kind of natural law that if we know that debt's going up, then ultimately assets are going up versus GDP. And so we look for mean reversion opportunities. Stan said he's sure that there's going to be just these disturbances in the force are going to create opportunities. What is an opportunity? Here's the mean, here's the spot price. It's trading way below, right? And you buy here, and then this perpetual wave of mercantilism from overseas will generate the dollars, which will bid those asset prices higher. End of lesson. Hope you've enjoyed. I hope I haven't been too annoying, but always listen to Stan. Stan is the God. We bow in the presence of Stan's great trading record.